All right, so this is second quarter 2021 Regions Financial earnings call summary. Um, I really enjoyed going through this earnings call. This is the first time that Texas Investments has been involved with just a consumer bank. Usually it's insurance companies or investment firms, things of that nature. But we're currently invested in a really consumer focused bank. And so a lot of what we get in the earnings call um, speaks directly to exactly what's happening in the market as far as, just ordinary average people. Um, I will say that the report was okay. It's not great, but okay. They did mention that loans for their corporate customers were up about 20%, and that is without the PPP and all those things. But the problem that I have is that because of all of the PPP and all of the other COVID type loans that are out there, I'm certain that a lot of these numbers for these banks are inflated, right? Um, if COVID were not here, I'm not sure that they would be pushing these same numbers. And so what that means for me is that once COVID is over with, we're going to see these numbers drop dramatically. Um, and when compared to the COVID numbers that we have now, it's not going to look very good for the banks. They did mention that the deposits were up, meaning that people have extra money to put in the bank, and they are actually putting it in the bank versus spending all of it. So that goes to show how the money supply is actually outgrown demand, which is where I think we are right now. We also know that the consumer price index has been pushing up consistently, again, pointing to the fact that there's just way too much money out there. Regions Financial reported that they have something like $23 billion sitting in cash right now, which is almost 20 times what their normal cash position is. And so that's not great. They are trying to use that cash to make more money, but for the most part, it's just sitting there collecting, a tiny bit of interest from the Fed. They also mentioned that debit card and credit card transactions were up. But again, if you have more cash sitting in the bank, right? Um, then of course debit card and credit card transactions are going to go up, but that doesn't mean that people are actually buying more things. It just means that they have more money to spend, but they still have so much extra that it's just sitting in bank accounts basically. And so at some point, um, either the cash is going to run out, or we're going to have demand pick up. And I think a lot of this is concerns because with the COVID and really not knowing kind of what's going to happen over the next year. Um, the other thing that was really interesting in the call, they discussed their short-term hedging investments. Right now, Regis Financial is hedged for lower interest rates. Talk has been going on, and I've discussed this in previous videos about the interest rate possibly going higher. As of now, the Fed has not decreased the interest rate, but they also have not moved it higher. And so, um, will we see that happen? Um, well, we have to assume that at some point the rates will go up. The question is just when, right? Regis Financial, they said they're hedged until 2023. So I think that is probably a good indicator of where the Fed is most likely to move. We're coming to the end of 2021. We still have a bunch of cash going out as far as the child tax payments. Unemployment, I think, is still going until the middle of September. I don't think it'll be until November or December until we really start to see how this is going to shape out. There's reports of companies wanting to hire but not able to hire. And so maybe once unemployment is done in October, November, maybe we'll see that hiring ramp up. Again, the cash is still floating out there. So a lot of that cash really has to come out of the system before we see any type of movement as far as equilibrium with demand and supply. And just to make sure that it's understood what I'm talking about here. So demand is, how much people want as far as things and services, right? And they have to have the money to buy those things. When you don't have the money to buy those things, meaning that supply is not meeting demand, that's what you would call a depression, right? Because there's a high demand for food, but no one has the money to purchase food. And so typically that brings the prices of food down, right? Currently, in the economic situation that we're in, we have a whole bunch of money, too much money, way too much money. And not enough demand. People aren't spending a lot of money, and so what that does is that it pushes the prices higher because people have more money to spend, and so again, that's why we see the CPI index going up. And like I said, that's not great for banks. Banks make money on interest. Currently, Regions Financial, if I can get to this really quick, they're running something like 3% is the difference between what they're borrowing versus what they're loaning out at. And so 3% is not it's not like great, but it's not bad either. I mean, at the end of the day, that's what the business does. And so a 3% profit, it's still profit. It's a decent business model. The other thing that's really hurting all banks right now across the board is the NSF fees completely coming out of the system or really being tempered, right? So Regions Financial is still making money on those non-sufficient funds fees, penalties rather, but they're decreasing a lot, and Regions Financial expects all of that money for NSF fees to come completely out of the system. There is a graphic in here showing one of the new accounts that they are coming out with next year, which will have zero non-sufficient fund fees. Here we go. So this is coming out, at the end of this year actually, and so I mean it's not going to have any overdraft fees at all, which means the bank is not making money, right? Now the one good thing that did kind of stick out here is that because you have all of these loans and things like that going out, most of the banks, and most of the banks require you to have an account at their bank, right, in order to get one of these loans through them, okay? And so what that means is that Regions Financial is charging money for these accounts, whether it's $5 a month, $10 a month, $15 a month, whatever it is. They're able to make money that way. And they say that because the NSF fees are coming out, they say they'll make it up on the back end with mortgages and deposit account fees. But I don't know. I think it's definitely going to hurt everyone in the banking industry, in the consumer banking industry anyway, to have those overdraft fees come out. But that's a political risk, right? I mean, that's just kind of where we are, um, and what is expected of banks right now in the U.S. They did have some acquisitions, so I want to talk about that just really quick. Highland, these are small acquisitions. They didn't speak to what benefit these acquisitions are going to have to the earnings. At this point, we have to assume that these are just going to be add-ons that will help drive business to the bank, right? So the first one is Highland. They deal primarily with nonprofit hospitals and medical facilities, and just managing their finances, managing maybe their investments, right? The other is Ascentium. I think I'm saying that properly. This one is kind of interesting because it really does put Regions Financial in a different space than what they have been traditionally, which is usually with a bank, right? You go in and you ask for a loan and you pay that loan back, right? With Ascentium, what they're doing is they're allowing business owners and small business owners to offer financing to their customers. And so not only do you have an opportunity to develop a relationship with the customer that's getting this financing through Ascentium, but you also have the opportunity to develop a relationship with the business owner that's using Ascentium to offer this financing. So this one is interesting. Again, they didn't speak to how this is going to benefit the bottom line, but it is a nice add-on, I think. The other big one is Interbank. This one has been talked about quite a bit over the last month or so. They deal primarily in home improvement lending, which was really a hot topic before COVID. Now I think that's kind of come down some. There's still talks of new homes not being built, and so what that means is that you have more people that are more than likely going to purchase an old home and then improve upon it, or improve upon an existing home that they're currently in. Interbank is primarily in the Southeast, as is Regions Financial. They deal primarily with AC, heat, and swimming pools. So, we're not talking about kitchen. We're not talking about add-ons or anything like that, other than maybe, like I said, a pool. But definitely going in and redoing the HVAC is really important. And so, especially in the South, right? You want to make sure that your AC is blowing cool. So that's kind of cool. Let's see. There was one other thing that I want to discuss right on top of my head, but I need to find when I see it, it'll come to me. Talked about hedging. Talked about PPP stuff. Counts. Deposits. Oh, okay. Yeah, this was something really interesting. So they said that they got rid of a lot of they got rid of a lot of their branches. Something like 215 branches were completely shut down. But they did open up 75 new branches. They said in more densely populated areas. They also said that their expenses were a bit down this quarter, which is a good thing, right? But they were down because of payroll. And so, kind of reading between the lines, we have banks a lot of banks, a lot of companies right now in the U.S. that are closing down their physical locations. Um, if these companies own these locations, then that means that you have a lot of commercial property now on the market, um, that's that either isn't getting sold, or is getting sold at cheap prices, right? And if you don't sell it, if it's just sitting there doing nothing, you still have to pay for maintenance, right? Um, which means that at some point they're going to have to recalculate their assets on the book, right? Because if you own a commercial property, and let's say it's valued at $1 million, right? Part of that value is the utility of that particular property. Part of that value is the resale value, right? But if all of a sudden you now have an asset that's sitting on the books, not doing anything, like it's not making you any money. All you're doing is spending money to basically keep it up to code, right? That's a negative. That's a negative. Not only that, but if you turn around and say, okay, well, we don't need this branch anymore. We don't need this property anymore. Let's get into the market and try to sell it. All of a sudden, you find out no one is purchasing commercial property at the moment, and if they are, they're not going to pay what they would have paid in 2019. You know, and so at some point, I think a lot of these companies are going to revalue their balance sheets, and we're going to see a big hit to the assets. Um, and the other thing too is we talked about there being so much money in the market, and we talked about there being companies that are trying to hire and can't hire. I don't know how true that is. I hear the stories, but I don't know. Regions Financial clearly laid off a lot of people. They did report that they hired more people, but clearly, if the payroll was less this quarter, it's because they're paying less people. There's just no getting around that, especially if you close 200 branches, right? Um, Meaning there's a lot of people out of work. There's a lot of people out of work, and these branches are not going to just reopen. Like, why would they, right? Regions Financial has moved everything to remote. So their customer service is 100% remote. A lot of their loan products, a lot of their services like wealth management, things of that nature, is all remote. So we talk about this reopening and whatever. Um, what are they going to do? Go from 100% remote to now what, 50% remote, 20% remote? So I again, um, whenever you go through these earnings calls, the CEOs and COOs, they try to paint a rosy picture, and you really kind of have to read between the lines to see what's really going on. This just doesn't look good. Doesn't look good. Um, the fact that they're bringing in more people into the bank to open up these accounts, and they're charging these monthly fees is great. But how many of those people are going to stay once the loan proceeds run out, right? How many of these people, after the loan proceeds and unemployment run out, are going to continue having an account and depositing money into it? Are they going to have a job to go to after all this has happened? And honestly, I'm not so sure that's the case. Um, so again, we'll see. I really enjoyed going through this. We will probably be in this position for at least another quarter. So I do look forward to hearing more about the consumer sector. This slide I put up first, I thought was interesting. This is Regions Financial idea of kind of the high risk businesses right now in the economy, and also their portion of loans that they currently own, right? So they're saying here that roughly 1% of all of their loans are from companies in the oil field, which they consider high risk right now. Consumer services, travel, amusement, arts, recreation, taxis, and then retail, clothing, retailers, and then full service restaurants, and then of course hotels down at the bottom. So these are high risk areas for the economy. Again, I've heard stories about restaurants needing to hire and can't hire, being that it is such a high risk industry at the moment. I just don't know how true that can be, right? But again, we'll wait and see. The next earnings is going to be in September, October, so it's right around the corner. Until then.